recent bank failures that have happened in the US, where it looks like equity holders were preferenced over bond holders. Now, arguably, this is changing some of those laws on a whim. Now, tell me, how is the implosion of those three banks in the US in 1 week, the Silicon Valley Signature Bank and Silvergate Bank, with I think First Republic wobbled a little bit after. How has that shaken the market's faith in the supposed rules of the financial markets that we're meant to follow?
Well, we don't know yet, and that's the interesting part. What we know is Silicon Valley Bank went to the wall. What we know is Silvergate went to the wall. What we know is Signature Bank went to the wall and was taken over by the FDIC. What we know is First Republic wobbled. What we also know is the response by regulators was equal parts sensible and foolhardy, in my view. And I wrote a long piece about this at the beginning of this month. The backstopping of depositors, I think, will turn out to be another potentially catastrophic knee-jerk reaction to a problem, because whether she likes it or not, and Janet Yellen was questioned on the Senate Banking Committee by Senator James Lankford of Oklahoma shortly after this, whether she likes it or not, whether she realizes it or not, and it seemed amazingly that she didn't quite realize this, but she's just backstopped $17 trillion of deposits in the United States, because to decide one bank is systemic and let another bank fail in these highly polarized political times is pure folly on the part of Janet Yellen. And so when he questioned her about, my constituents in Oklahoma, they're small banks run by farmers. Are you telling me if those go down, they're not backstopped? She said, well, no, we decide who is systemic or not. But if you take a look at the loan books and the asset books of the various banks, and look at banks with assets below $250 billion, which is basically the kind of signature mid-sized banks of the world, they account for just about 50% of real estate lending and consumer loans and commercial real estate lending. So you just can't make the argument that they're not systemic, because if there's a run on one of those banks and they don't get backstopped, as we saw with Silicon Valley Bank, all that money flows into JP Morgan, Bank of America, Citigroup, Wells Fargo. We all know the names. And that will happen again. So, unless you backstop the failing bank, you're going to see that run, and it will have exactly the same consequences, only much graver this time because of the recent memory bias people have. They will act much quicker this time if they see a mid-sized bank going under. And thanks to mobile banking, the run on the bank can be absolutely extraordinary. Back in the day, if they wanted to slow the bank run down, they would close all but one teller window. It was as simple as that, right? You pull the blinds down on 9 out of the 10 tellers, and you slow the run down by 90%. It really was that simple. You don't have that luxury anymore because everyone's on their phone, sitting in the bathtub going, oh, damn, I need to move my money. So the rule of law, is one thing. The laws of finance, and I'll put laws in quotation marks, are another. But there's a degree of uncertainty as to what the actual rules are anymore, because there's been so many bailouts and so much moral hazard. This time around, they were very clear, very early in the Silicon Valley piece, that they were going to stick it to shareholders, which is the right thing to do. That should have happened in 2008. They've learned their lesson from 2008, and we're explicit that we are going to zero out the shareholders. So we've kind of moved one step back towards the laws that people understand, that when there's a bankruptcy, the shareholders get wiped out. But are they going to wipe out the bondholders? No, they're not. Are they going to protect depositors? Yes, they are. So we've got another kind of fuzzing of the lines between what we understand the rules to be and what they actually are. And it's moral hazard writ large. So we're going to lurch from crisis to crisis, or potential crisis to potential crisis, and the responses are going to be similar in nature, i.e., we will throw as much money as this that we need to, and at the same time we will try and send a tough message so that it doesn't happen again. But realistically, until the pain is felt, real pain is felt, i.e. they let a bank go under and the FDIC says, if you had more than $250,000 in the account, I'm really sorry, but that's the extent of your insurance. Or, as they have in Europe, deposit holders get bailed in to bail the bank out, and they all get a haircut on their deposits. Until that happens, you're reinforcing the notion amongst investors and depositors that it won't happen. When push comes to shove, we'll get bailed out. And so, somewhere down the track, there's a nasty awakening coming for somebody. And one would imagine it's going to be at some point some kind of bondholder / depositor. And we saw this in the Credit Suisse when the AT1s got zeroed out as well. That's where this shock is going to have to happen, because otherwise the Fed's balance sheet is going to be, as my friend Felix Zulauf said at the start of the year, $50 trillion when they take everything and all this stuff on their books. And that will take care of any questions we have about the viability of the dollar, because it will, trash it. So, it's a very complicated time right now, because there are really big tectonic plates shifting in finance, and it's not a case of, is Apple going to go up because their factories reopened in China? These are massively macro, big picture shifts happening that are very difficult for people to get their heads around, because they are not a number on a screen or a 3-letter ticker or something. These are geopolitical / high-level regulatory tectonic plate shifting. And the effects of them might not be felt immediately, but like aftershocks of an earthquake, they can kind of come rippling back through the economy, through the financial system for months after. So we really don't know what the events of the last couple of weeks are going to ultimately lead to, but it's going to lead to more instability. And that's something that every investor should be aware of and have a plan to deal with.